Alrighty. So today's video, we're going to be talking about a rather interesting named option strategy. It's called the Jade Lizard, and this Jade Lizard has a 90.42% win rate. Alright, so this name, it sounds very fancy. It's actually coined by the folks at Tasty Trade, right? They run the brokerage, Tasty Works, and actually the founder was the one who created the Think or Swim platform, right? So although this name sounds very fancy, it really just is a combination of two option strategies. All right, so first of all, the Jade Lizard is a neutral to bullish strategy, and it's a combination of two things, right? You have the cash secured put, which I've already talked about rather extensively in other videos on my channel. You can just go ahead and watch them. And the other is the bear call spread. So the bear call spread is a credit vertical spread. Now, if you take a look at the cash secure put here, right, I won't go into all the details you can see in the other videos, but I wanted to point out just the break even point down here. So you can see it's 376.73 because I wanted to compare it later on, as you can see, versus the Jade Lizard. All right, so this has 89.5% win rate just for the cash secure put. Now, let's take a look at the bear call spread. So previously, I talked quite a bit in my other videos on the put ratio spread, where it's a combination of the cash secured put and the bear put spread. So the bear put spread is a debit spread. So the whole idea there is to use the credit which we receive from the cash secured put to finance the bear put spread. But for this is actually a credit spread. So that means you're actually receiving a premium for selling this credit spread. And unlike the bear put spread, right, where the bear put spread, what we are doing is we are selling, buying and selling the put spread below where the market price is. So let's say, for example, the stock price is, what we'll be doing is we're actually buying and selling. We'll be buying a put spread here, maybe selling a put spread here, which is below the current stock price, right? But for the bear call spread, we actually want to sell the call spread above the current stock price. So you can see this is the current stock price right now. So what we do is we sell the short leg, right? The short leg will be somewhere above, right? So we will be out the money, right? Somewhere around at this point, and then we will buy back a leg, a call option further out the money, right? The whole idea here is because we want to limit our losses to the upside. And the whole idea of the Jade Lizard down here is that our credit which we receive has to be more than the width of this credit spread. And the reason is because this is our loss which we are taking here. So if the credit which we receive, this too, we receive more than the width of this spread, that means that we have no risk to the upside. So I'm going to show you the graph, right? So basically it's the cash secure put plus the bear call spread, and we get this. So this is what you call the Jade Lizard, right? So as you can see, it shares very similar characteristics as the cash secured put. The only difference is that you can see down here, the cash secured put has a uniform profit, right? That means the amount which you receive doesn't change regardless how high up the market goes, right? It can go all the way to 540 to 500, it's still the same. Whereas for the Jade Lizard, what you're doing off is kind of a little bit of a trade-off, right? You get more profits in between the short strikes, right? The short strike between the put and the bear call spread which you're selling, but then you forego most of the profit this side. So the whole idea down here is that you feel that the market is more going sideways, neutral to bullish. So this is where the current market price is. All right, so basically the market can go all the way to this point down here, the break-even price, and up to here, right? We'll still make some money. Now anything above here, we still make money as well, but it's just very little, right? So you can see that the profit has dropped off significantly down here, but the whole idea here is that there is no risk to the upside. So they have created this strategy basically to take advantage of a very neutral market, right? That means the market is pretty much going sideways. You expect it to stay in within this range. So this is where you will make more than what you would if you had just sold the cash secured put. So if you see the cash secured put, you just made this amount, but they sell this bear call spread, or rather this strategy has this bear call spread to help you increase the profit on top of this. All right, the profits that you have from the cash secured put, rather the premium. So this will result in this kind of strategy. Okay, so I want to go through very quickly the trade mechanics of the Jade Lizard. So ideally you want to go somewhere between 30 to 45 days, right? So because this is a premium selling strategy, that means we want theta decay. We want time decay on our side. So ideally, if you were to take a look at the theta decay curve, the time where the decay will really start to pick up is from the 45 days onwards, closer towards the expiration of the option, right? So we want anywhere 30 to 45 days. Now there are some people who like to do the Jade Lizard, when there's like 14 days left, 10 days left, so that they can get more return in terms of percentage. You can do that, but one thing you have to keep in mind is that whenever you're using a shorter time frame, it means your strike price is closer to the market, right? So if this is the current market price, this is the current market price. If you were to go to a shorter days to expiration, if let's say you're going for something like 20 deltas, right, or 25 deltas, you notice that this is the strike price that you can only go for, right? Maybe it's just a few points, maybe 10 points, let's say for example 10 points from the market. But if you will go to the 30 to 45 days, maybe you're able to get a 20 to 25 deltas here, which is slightly further from the market price. So you have slightly more of a margin of safety, because we need to understand that the risk is always on the downside, and when we enter a trade, we want to know what is the worst case scenario. So the worst case scenario, because we are selling a cash secured put, which means to say there's always a chance for us to get assigned on this put, where we'll have the obligation to buy 100 shares, so would you rather buy 100 shares at a higher price or at a lower price, right? So obviously we want to always get at a lower price, right? So it becomes easier for us to make money as the market goes up, and the risk is also lesser. So that is why you might want to go for a slightly further away days to expiration rather than the shorter ones. All right, now the next thing is the premium. So the way you want to construct this Jade Lizard is pretty interesting, right? Because you want to ensure that the cash secured put it takes up only about 70% of the premium of this whole trade, right? If you were to take, like, let's say 90% of this premium, but then the bear call spread is only 10%, then it doesn't make any sense for you to sell the bear call spread in the first place, because you have kept your upside and then you're only making an additional 10%. So this is where the balance comes in. You want to have quite a juicy premium for the bear call spread, so it justifies you actually selling the bear call spread. But yet again, you don't want it to be too much, right? Because if you take 50%, what happens is that you have to put it very close to the market price, right? You may have to sell, let's say this is the market, you may have to sell somewhere down here, your credit spread from these 2 points, right? And it becomes to a point where you have such a small amount of room to wiggle before it gets in the money. So that is why you want to balance it somewhere. So the folks at Tasty Trade have given a guideline that you want roughly to be about 30% of the total premium received. All right, so later I'll share with you how you can construct this on the trading platform. As for the strike price, right, generally I like to use for the cash secure put anywhere from 15 to 25 deltas, and for the bear call spread, it has to be higher, because when you're selling a spread, you can't get as much premium as compared to a single option, right? So with the spread, because you're selling one option and you're buying one option, in order for you to get more premium, you have to sell it closer to where the market price is. So that's why you have to sell roughly around 30 to 35 deltas in order for you to achieve around the 30% premium buck. Now next, risk management. All right, so this is the most important part. What do you want to do if the trade goes against you or goes for you, right? So the first thing for the Jade Lizard is how you take profit. So generally you want to just take off 50%. When it reaches 50% of the premium you've received, just take it off the table. Now the next thing is to understand what you're going to do if the trade goes against you, right? So this is the Jade Lizard graph. So your greatest risk is if the market goes past this break-even point. So what do you want to do once it gets there? Again, we must always think of the worst case scenario before we enter a trade. So what do you do? So if it goes below, let's say the current market price is here, it goes below your break-even price, the first thing you want to do is you want to close out this part of the trade. So this part of the trade, which is the bear call spread, will most likely be in almost the max profit, right? Should be about 80% or more of the profit. So this is where you want to close it out. So you will close out the bear call spread, So now this is where you have a couple of options, right? The first option is that you could obviously just leave it alone and then get yourself assigned, wait for the market to go back up, and then you sell off the shares or sell a covered call, right? The other way is if you do not want to get a sign, you can roll it, right? You can either roll it out, that means you roll out to a further expiration date at the same strike price, or you can roll out and down. That means you could roll out to a further expiration date, but you roll it down to a lower strike price. So this way, it gives you a better chance of profit, right? Or you could just let it expire worthless. So you can see that this is the most important thing you need to understand as you enter this trade. Alright, so I want to share with you very quickly a Jade Lizard trade that I did on the IWM, which is the index ETF. So when I do a Jade Lizard trade, I generally prefer to do it on the index ETF as opposed to individual stocks because of the strike selection. Because with index ETFs, you'll notice that the option strike prices which they have can be just $1 wide, right? Whereas for individual stocks, it could be $5 wide, and this could be hard for us to construct a upside riskless Jade Lizard, which I'll share with you later on in the trade when we get into the trading platform. Alright, so for now, for this, you can see I sold two Jade Lizards, right, on the 23rd of September. I received a credit for $2.12, that is $4.24 in total, and the strike price is at 200 for the cash secured put, which is below this point, right? And the bear call spread, the short call is 231, so this is the short strike 231, and we have 233 as the long call leg. So anything above this are basically just pretty much make very little, right? But I stand to make the most if the market stays in this range. So I anticipate this market, right, or rather IWM will stay in this range, because as you can see, it has been moving in a range for quite some time right now, and I anticipate that it will keep, you know, keep doing the same thing. It will bounce off this high and go back down again, right? So on the downside, you can see that there is a number of support levels, the previous lows, that the IWM has to break through before it can get to my 200 strike price. So again, we must anticipate, or rather we must find out what is the worst case scenario before entering into the trade. So in this case, the worst case scenario will be getting assigned 2 contracts on the $200 strike price. So the question is, are you going to be okay with that? So for me, I'm fine with that, because I do have the funds to get filled, all right, to get assigned 200 shares at this strike price. And because this is an index ETF, in the long term, it will always go back up. So again, I already have my plan that if it does reach the break-even point, which is below the 200 strike price, I will close out the credit spread, which is the bear call spread, and then I would roll this 200 strike down. So when you enter the trade, this is the kind of a thought process or a plan that you must have in case the market does not go the way we want it to. On the 8th of October, as you can see, the market in the end did go sideways, right? It started to just bounce back and forth within this very small range down here. And on the 28th of October, I closed it for $1.05, right, for each contract. So I sold at $2.12, I closed it at $1.05, and this was just a GTC, a good till cancel order. So that means the moment I place this trade, I place a GTC order to close the trade when it reaches $1.05. That means I've profited roughly about 50% on the premium which I've received, right? So for this trade, the total profit is $2.12 minus $1.05, which I paid for it, and then I times 2 contracts, so this gives me a total profit of $214. Now the ROI for this is $2.14 divided by $400, because I have 2 contracts at the 200 strike price. I divide this by 15 days because it took 15 days from this point to this point to close out my trade, and at times 365, it gives me a 13.02% return, which is okay, which is not too bad, rather decent. All right, so this is the Jade Lizard trade. Alright, so I want to very quickly go through how you can construct the Jade Lizard on the trading platform. So this is a TD Ameritrade. So the first thing I would do is to just choose the strikes, right, the days to expiration first. So as you can see, there are a number of strikes down here. So for this is the spiders, SPY. So what I'll do is I'll go to roughly the 30 to 45 days, right? So I've already chosen some strikes down here, as you can see. So this is on the 44 days to expiration. So what I want to do is I want to first choose the cash secured put side, right? So I would go for roughly about 15 to 25 deltas, and then I will start to arrange it from there, right? So this is the delta column. So I want to go all the way to around the 15 to 25 delta mark. All right, so this is 16 deltas. So 16 deltas, as you can see, is the one which I've selected, 380. So we'll start off with the 380 strike price first. So 16 delta is roughly around 1 standard deviation. And let's take a look at our short call side, or rather the call spread side. So on this side, right, the strike price we have chosen is 427. So 427 is somewhere here, right? So on this side, you can see it's a delta about 33. So for the bear call spread, we want a delta of roughly 25 to 35 deltas, right? Then from there, you want to see where you can have the long call leg, where you're going to put it, right? So the whole idea down here is that this total credit has to be more than the width of this bear call spread. So you can see this bear call spread has a 4-point width for this, which means to say the maximum loss on the upside will be $4. So in order for you to eliminate the upside risk, you need to receive a total credit, right, for both of them to be $4 or more. So in this case, this is $4.57. So this is more than this width of $4. That is why you can have a risk-free, or rather you do not have any risk to the upside on the graph. So as you can see, this is the P&L graph. This is the risk profile of the Jade Lizard. So you can see individually, this is how it looks like individually, right? You have the cash secured put, and you have the bear call spread down here, right? So if you join this both together, you will see that on the end down here, there is no risk. In fact, the profits you will get at expiration, if it goes above, right, all your bear call spread strikes, you will still get roughly $57, right? That's at expiration. So there's absolutely no risk to the upside. Now you can change this as and when you want, as you can just manipulate the strikes, right? But basically you want this to be roughly 30%. So how do you know whether it's 30%? First, you start off always with the cash secured put, right? So if you sell the cash secured put at $3.22, what I do is basically just this, right? I just take 3.22, I divide by 7, which is like 70%, and then I times 3. Right, so this will give me a rough gauge. This is the amount of credit I need to hit for my bear call spread. So this is where I will arrange, right? So let's say if I had started off with the 430, which is around the 29 deltas. So let's say if I started with 430, I want to arrange this to see how much credit I can get and where's the worst I can get. So the easy thing you can go is go to the risk profile. So if I go to the risk profile, you can see that I actually still can get a profit on this side of the spread, right, of this Jade Lizard. It's still an overall profit, even though if the market was to shoot past the strike. And what this does is it helps me increase the width of this Jade Lizard, right? So this Jade Lizard has now a bigger max profit range, right? Although you are profit all throughout, this is the max profit range, which is somewhere in between. Now the issue down here, or rather the dilemma you face, is that this credit is not high enough, because 1.15 is not the 30%, right? So if you take 1.15 and you divide it off by the total of this, which is 4.37, you see it gets roughly 26%, right? It's pretty close, but it's not 30% yet. Right, so you can do this. So you can see this is a trade-off. If you're okay with a lesser credit on this end, then you can go ahead and shift it, right? You can even shift it maybe to 432, and then let's take a look at 436. Do we get a credit? Oh, so there you go. You actually get a credit here as well, and it's overall still a profit. You can see $25. You can probably even push it a little bit more. All right, 435, and let's see 439. What do we get? Alright, same thing. Alright, this is just nice. We have a $7 profit. So what it does is it widens the maximum profit that you can gain, but then you reduce the amount of profit towards the end down here. The problem down here, you notice, is that you're only getting 85 cents for this. So you're pretty much cutting off any upside rewards, right, just by taking on an additional $85 in profit. So that doesn't really feel worth it, because if you had just sold the cash secured put, if the market was to really rally past this point, you'll be getting the full $3.22, right? And then you'll be capping your upside just by taking an additional 85 cents, right, which is $85. So this is where you want to balance it off. So as a rule of thumb, right, you want it to be around the 30% mark. So this is how you construct the Jade Lizard. Now you can of course push up your cash secured put price. Maybe you want to push it up to 385. So what you want to know that if you bring up your cash secured put strike price, your break evens also get pushed up. That means now your break even is not as good as before, right? It gets pushed up, but your overall credit increases because you get more on this cash secured put. So what this does is that when you get more on this cash secured put, you may be able to increase the strike, right, on this. So maybe instead of 4 points, maybe you can try and squeeze for 5 points, right? So if you get 5 points, you can see down here you get more credit on your bear call spread, but you get a loss of roughly $8, right, if it goes above your long call strike price. So what you can do, you can adjust it, 434, change to 439. So there you go. This is a $1 loss. Let me adjust that again, and so it will be basically like this. All right, so you can just mix and match, right? You can just change it, manipulate the strike price as well until you come down to something that you feel comfortable with. But always, as a rule of thumb, you want this to be 30%, so it makes the justification for you to actually sell the bear call spread instead of just selling the cash secured put by itself. Now let's take a look at the individual stocks, right? So let's say I go for IBM. All right, let me just clear all this out. So on IBM, alright, so this is one of the issues you will face if you do with individual strikes, because if you notice that the strikes are actually every $5. So now this becomes a little bit for you to construct the bear call spread, right, to match the credit you want to receive total and the width, because now the width, the maximum or rather the minimum width that you can have is 5 points, which means to say you must receive at least $5 in credit for the both of them. All right, total. So let's try and construct one Jade Lizard here, and you will see the problem which we will face. So let's say the delta. All right, so because there's not that many strikes, as you can see, so the delta is limited to just 3 choices. You have the 41 delta, 24 delta, and 14 delta. So we want something from 15 to 25, so let's go for this. So 1.55. Now this is the bid price, right? Remember, when we are selling any option, any single option, we want to try and get the mid price, so I will always change this to the mid price, which is the mark, which is around 1.64. So this is roughly the price that we should be able to get if we were to route this order. So 1.64. So now let's take a look at the call side. Let's see what we can sell for the bear call spread. So let us see the delta. All right, so we want something like 30 to 35 delta, so the closest will be this. So what we do is we analyze sell trade and we do a vertical spread. So this will give us 135 and 140. Now you see, this is where the problem lies. You have a 5-point spread, so you need at least $5 in credit to cover this spread, cover the loss on the upside. But if you take a look at the total credit, you're only receiving $2.84. That's not enough for you to cover. So if you take a look at the risk profile, you will see that actually you now have risk on the upside. So this is not an ideal situation, and it defeats the purpose of the Jade Lizard in the first place. So how can you actually change this to match, right? So in this case, you may have to just sell a higher strike price for your cash secured put. So if you cash your cash secured put, if you sell 130, let's see what kind of credit you can get. Let's take a look at our option chain down here. So the mark price is about, let's say we round it up to 3.15, right? So you can see 3.15 is still not nearly enough, right? You get $4.30 something cents. So in this case, you can see we still get a loss of about $65 past our long strike price on the call side. So this, you can't really build a Jade Lizard here because it gets a little bit too difficult, and you don't really want to shift this strike price down for your call side, because then it becomes right at the money, right? You'll be too difficult. In fact, if you shift to the 130 strike price, you're actually selling an in the money call option when the current price is 132. So as you can see, it just doesn't match up down here. So that is why I don't really like to do a Jade Lizard. You can't really construct one good one on individual stocks. All right, so the last thing I want to show you is that you can actually route this for a single order ticket, right? You want to route this as one single order as opposed to two orders, because if you're legging in this way, you're going to have legging risk, right? The price may slip away before you sell this and you're going to miss your credit, and you don't want all that shenanigans, right? So what you want to do instead is you want to input everything into one order ticket. So the way you can do that, at least on TD Ameritrade, the way you want to do that is to do it on using options that have three legs, right? So you do a three-legged order ticket. So a three-legged order ticket, right? So the one I'll go for would be butterfly, right? So you see, butterfly has three legs, so just nicely match this. But for this, what you have to do is you have to change the custom and then match this, right? So you want to be selling this, so you match sell, sell, buy. So sell, sell, buy. I'll change this to minus 1, so you can see it's minus 1 plus 1, so it matches here. Your expiration date is all the same. Now you want to change the strike price to match the strike price of the actual Jade Lizard. So I'm going to change this to 385, change this to 433. As you can see, there's some manual work involved down here. Change this to 438, and then the next thing you want to do is remember to change this to the right type of option, right? You want to change this to put, call, call. So there you go. So you get roughly a credit of $5.08. So it's pretty much the same down here, right? So when you match these two off right now, you have the Jade Lizard. All right, so you want to route this for one order ticket so that you get the right pricing. All right, guys, so I hope this video has been very helpful for you to use this Jade Lizard in your own trading, especially if you see that the market is going sideways. That is a good time for you to use the Jade Lizard. All right, guys, so I hope you liked this video. If you do, please give me a thumbs up, and also please subscribe to my channel for more videos like this. And as always, thank you for your time, and may the options favor you.